In the brilliant galaxy of modern financial markets, few investors have achieved what Stan Druckenmiller has, maintaining an annualized return of approximately 30% over decades of macro trading with no losing years. From Fonte Duquesne Capital in 1981 to closing a fund in 2010 and now managing his family office. He was not only the key trader in George Soros' famous shorting of the British pound, but also one of the absolute masters of macro hedging. Yet, even this legendary figure, revered by the industry, recently reflected on his Nvidia trade and admitted to an emotional mistake, selling too early due to excessive profits. When asked in an interview whether he would have made the same mistake 20 years ago and what lessons from recent years he must forget, Dr. Druckenmiller's response revealed a chilling truth for traditional traders. 20 years ago, I probably would have screwed up the same way. When I was young, since I never went to business school, I relied heavily on technical analysis. But I can tell you unequivocally, today, technical analysis is only about 20% as effective as it was back then, because now everyone is using it. TID no longer your unique edge. He also noted that the once ironclad rule, if bad news comes out but the stock rises instead of falls, a major positive must be coming. Termisa's completely sure sell, because in a market full of high IQ traders and sophisticated algorithms, such patterns have long been fully digested. This piece will guide you with an objective, rational, yet lighthearted narrative in Dr. Druckenmiller's deep entanglement with technical analysis over more than 40 years. We will examine his journey from heavy reliance on charts to his current reevaluation of their effectiveness, and in the second half, dive into the underlying logic behind the cliff-like decline in technical analysis's power. By combining shifts in market microstructure, the rise of high-frequency trading, and institutions' liquidity hunting strategies, we will fully reveal the top predator ecosystem that retail technical traders now face. To understand Druckenmiller's current disenchantment with technical analysis, we must return to the beginning of his career and appreciate just how dependent he once was on this tool. Rewind to 1977, when the young Druckenmiller joined in Pittsburgh National Bank. Lacking an MBA degree, he had natural shortcomings in traditional fundamental valuation, deep dives into quarterly and annual financial reports, and building complex discounted cash flow models. In that early Wall Street era, which placed extreme emphasis on credentials and formal finance training, his rise owed much to his mentor Sparrow Strell. In the bank's investment department at the time, Drell was an outlier who strongly favored technical analysis. Many colleagues privately thought he was eccentric for spending his days buried in thick chart books instead of meeting with company executives. But the perceptive Druckenmiller quickly realized that technical analysis had extremely high practical effectiveness in the opaque, slow information dissemination markets of that era. He fully embraced his mentor's methodology and integrated it into his own macro framework. Druckenmiller has publicly stated that he never used valuation to time markets. Instead, he relied on liquidity considerations and technical analysis for timing. Valuation only told him how far a market could go once a catalyst emerged to shift its direction. In an era dominated by human traders, obtaining real-time price data and drawing moving averages required enormous effort. Technical analysis was not just an analytical tool, but an extremely scarce, unique advantage. It not only helped Druckenmiller establish himself early in his career, but also saved him during one of history's most famous market crashes. The day before the 1987 Black Monday crash, based on technical chart analysis, Dr. Druckenmiller believed the selling was over because prices had hit a critical technical support level. On that basis, he flipped his portfolio from net short to 130% net long. But as trading unfolded that day, the price action and indicators sent extremely dangerous breakdown signals. Facing a move completely opposite to his expectations, Druckenmiller demonstrated remarkable mental fortitude and absolute obedience to technical signals. The day after the crash began, he decisively admitted his previous day's bottom fishing was a terrible mistake, quickly closed all long positions, and reversed to short prayed. This rapid correction, based purely on technical signals, allowed him not only to survive the epic plunge unscathed, but to profit handsomely. This survival experience in extreme conditions deeply imprinted itself on his trading philosophy, making technical analysis an indispensable tool for risk control and timing for a long time. As time passed, Druckenmiller's investment system matured, blending macro insights, fundamental catalysts, and technical timing. Yet in his classic Nvidia trade from 2022 to 2024, we see how traditional technical analysis experience created a psychological shackle for him. In mid-2022, hearing that top Stanford talent was shifting investments from KI tools to AI, and encouraged by his young partners, Dr. Druckenmiller first bought Nvidia around the $150 range. In November 2022, when ChatGPT launched, he immediately grasped AI's massive significance and doubled his Nvidia position. Soon after, in early 2023, after listening to tech analysts on a Morgan Stanley macro call, he doubled it again, solidifying his long-term conviction. Not long afterward, in mid-2023, Nvidia stock soared to $390, and Dr. Druckenmiller confidently declared in interviews, at that time, he believed he would absolutely not sell for the next 2 to 3 years. This stock could easily rise for another 3 years. But in February 2024, when Nvidia hit $800, technical indicators showed extreme overbought conditions combined with memories of the 1999 internet bubble. His psychological defenses collapsed, and he fully exited Nvidia by spring 2024 before the stock split. Nvidia continued surging to $1,400. Druckenmiller admitted feeling extremely regretful and acknowledged he couldn't stand such huge success. This dramatic trade perfectly illustrates how difficult it is to truly forget. As Dr. Druckenmiller described, forgetting does not mean simply discarding old knowledge, but requires the integrity to admit yesterday's errors when the world has changed, along with the flexibility to adapt to paradigm shifts. A famous quote from the CIE Analyst Handbook, often cited by investment masters, states, "When facing major paradigm shifts, the analysts who know the most about a subject often have the most to unlearn." Though intellectually aware, they, AI, represented an epochal technological revolution, Druckenmiller's 40 years of trading scars and muscle memory still exerted influence. From a traditional technical perspective, when a large cap stock's RSI's extreme overbought levels, mean reversion seemed almost inevitable. This technically severe overextension warning, overlaid with his first-hand experience of the manic prelude to the 1999 NASDAQ internet bubble burst, ultimately triggered his sell-off. He admitted being constrained by decades of experience, causing him to exit too early in the face of a true new era. This also explains why he began attacking technical analysis weaknesses. Because it has become so simple and accessible, it can make traders lazy. They just glance at a candlestick chart instead of deeply probing the grand narratives behind fundamentals. Old maps, after all, cannot find new continents. Dr. Druckenmiller summed up the sharp decline in technical analysis effectiveness with a brutally straightforward conclusion, because now everyone is using it. This seemingly casual remark actually touches the core of financial market ecosystem evolution. Drawing from academic research and real-world postmortems across the web, we dissect the underlying reasons for this plunge in effectiveness from 4 dimensions. In the 1980s, technical analysis was an asymmetric weapon, mastered by only a few. Today, any retail investor with a brokerage account can access millisecond-level data streams for free and add hundreds of complex chart indicators with one click. From an academic perspective, this confirmed George Soros' Franco theory. The theory posits a bidirectional feedback loop between market participants' perceptions and fundamentals. For example, when too many observe and act on a technical pattern, like a head and shoulders or breakout buy, their collective behavior alters the asset's price path from what it would have been. If everyone sees a resistance break and buys simultaneously, the result is not a smooth uptrend, but often a brief crowded stampede, followed by rapid exhaustion and fake outs. It's akin to the observer effect in quantum mechanics. When everyone follows the old script in trading, they shift from observers to participants, altering the paradigm and producing different outcomes. This leads to the widely studied alpha decay phenomenon in academia. Recent quantitative research shows that price pattern-based strategies' excess returns decay rapidly once widely recognized. Studies indicate that mechanical factor strategies like momentum or mean reversion have become extremely crowded. With more ETFOs tracking them, chart edges that once lasted weeks are now erased in minutes or even seconds after a breakout. Recent statistics confirm this. The failure rates of traditional chart patterns have surged dramatically. Take a few classics as examples. The head and shoulders top bottom pattern has a failure rate around 50%, heavily disrupted by macro noise. Bullish-bearish pennant patterns fail about 40% of the time, especially prone to whipsaws in weakening trends, with failure rates as high as 50%. Classic patterns have devolved from probabilistic winning weapons into little more than coin flips. Druckenmiller specifically highlighted one failed iron rule. If bad news hits, but the stock rises instead of falls, a major positive must follow. In the past, the logic rested on information asymmetry. When the public dumped on bad news, but the price held firm, it signaled smart money quietly accumulating, aware via privileged channels of impending major good news. But in today's highly transparent information era, that edge has been erased. Markets now teem with highly educated analysts, hypersensitive to macro data, plus round-the-clock natural language processing, algorithms, and news sentiment engines. When bad news breaks, algorithms parse it sub-second, assessing real impact on long-term cash flows and instantly hedging or trading accordingly. Thus, today's bad news not falling no longer means mysterious institutions are front-running big positives. See simply that smart money and algos have priced the news fully in moments, deeming it immaterial. Everyone thinks with the same playbook, anticipating others' anticipation, rendering the rule obsolete. The third deadly reason for technical analysis is reduced effectiveness is the fundamental change in liquidity providers and major participants. In the past, trading occurred mainly via humans on exchange floors or over phones, so human reaction speeds gave daily or weekly chart trends smoothness and predictability. Today, major asset classes are highly electronic, with high-frequency trading dominating. Statistics show the high-frequency trading market in the United States reached tens of billions of dollars in 2024, with North America leading globally. Investment banks and market makers use ultra-low latency infrastructure to control liquidity. High-frequency trading delivers a true dimensionality reduction, blow to traditional technical analysis, while retail technical traders stare at 5-minute candlesticks hunting support. High-frequency algorithms analyze ultra-microscopic order, flow imbalances, cross-asset momentum, spillovers, and options flows. High-frequency algos can probe with tiny orders to instantly detect dark pool or lit book clusters of retail stop losses or breakout buys. Academic studies show high-frequency traders strategically exploit limit order book information, providing liquidity on thick sides and taking it on thin sides. When retail piles orders at technical levels, algos can instantly intervene, steer price and cancel ahead of risk, leaving flash crashes or fake breakouts. Facing AI algorithms that process vast historical data with machine learning, retail-drawn support, and resistance lines are merely fragile parameters whose breach probabilities can be calculated and exploited in real time. If democratization stripped technical analysis of its mystique and high-frequency trading erased its time advantage, then institutions' widespread liquidity hunting strategies have turned it into a lethal weapon against retail traders. This is the most brutal, and most worth dissecting, phenomenon in current market microstructure. The starting point for understanding this is grasping large institutions, hedge funds, major banks, market makers, core pain point, scale. Their capital is too massive to enter or exit without liquidity, or massive orders cause severe slippage and skyrocketing costs. Like blue whales that cannot feed in shallows, they seek dense krill aggregations in deep waters. In financial markets, where are the densest? Order krill, precisely at key levels defined by traditional technical analysis. Textbook technical education teaches retail to place short stops above prior highs, long stops below supports, and trade breakouts around round numbers. To smart money, these supports and resistances are no longer walls blocking price, but seductive liquidity magnets. Retail stops are trigger market orders. When thousands cluster stops below support, they form huge external liquidity pools, paradise for whales. To harvest this liquidity, smart money institutions have developed highly sophisticated hunting mechanisms, often called the AMD model: accumulation, manipulation, distribution, accumulation phase, price ranges narrowly luring technical retail to short tops and buy bottoms, while piling stops behind obvious supports, resistances. Manipulation, liquidity, sweep institutions often pick specific windows, like London or New York open kill zones, to smash large orders, deliberately driving price through key support. This triggers a deadly chain. First, long stops below support, fire en masse as market sells. Second, breakout straddle technical retail, see the break and chase shorts frantically. Who buys into this avalanche? The orchestrating institutions themselves. They absorb retail's despair, driven mechanical selling to fill massive long positions invisibly and with minimal slippage. Retail chasing technicals unwittingly helps institutions complete their task, distributed displacement. Once institutions are stuffed with liquidity, the real move begins. Price leaves a long lower wick on the chart, then displaces upward at astonishing speed, trapping chased shorts and stopped out longs in chaos. These deliberate liquidity sweeps by institutions are the chief culprit behind today's sky-high chart pattern failure rates. Technical retail sees breached support as trend reversal, unaware it's just institutions' controlled demolition for positioning. As Druckenmiller lamented, there are now too many smart traders. When institutional algorithms fully master retail technical playbooks, traditional technical analysis ceases to be a crystal ball for the future and becomes instead a radar map for institutions to precisely locate retail stops. You trade looking at charts, while hidden top predators look at you. Stan Druckenmiller's career is essentially a living history of modern financial market microstructure evolution. His shifting attitude toward technical analysis, pure, early heavy dependence to using it as a lifesaver in 1987, to judgment distortion and deep reflection amid Nvidia's surge, profoundly reveals that in capital markets, no fixed methodology can last forever. Technical analysis itself has not died out, but its classical applications, simple, moving, average crossovers, breakout theories, basic chart patterns, have indeed suffered a cliff-like drop in predictive value. This is not because chart geometry changed, but because the observers, capital scale, and machine algorithms have transformed beyond recognition. In today's crowded, algo-dominated markets, where institutions routinely hunt retail liquidity, blindly worshipping traditional chart patterns is like trying to win a modern high-tech electronic war with a medieval spear. Today, the top traders, still profiting from technical insights, have ascended to a new dimension. They no longer try to predict direction purely with charts, but use them to gauge market psychology and locate liquidity-gathering hunting grounds. They tightly integrate technicals with macro paradigm shifts, learning to find safety, margins after institutions complete, sweeps rather than becoming the liquidity swept away. In this era of overflowing smart capital and rampant algorithms, investors must have the courage, like Druckenmiller, to confront their own muscle memory, stay open-minded, and admit the obsolescence of old paradigms. In this constantly evolving ecosystem, only by relentlessly shattering rigid cognition and deeply grasping the underlying game logic can one avoid becoming prey. The above is personal reflection only, not investment advice. Thank you for your company.